Good morning, students. Today we are going to learn and understand the concept of balance sheet in a non-profit organization and also how to prepare a balance sheet for a non-profit organization. As we all know very well that balance sheet basically consists of three important items. They are assets, your liabilities, and capital. But in a non-profit organization, we used to denote the term capital by capital fund. So the method of preparing balance sheet is same like how we prepared balance sheet last year in grade 11, whereas the term capital alone will be denoted by capital fund. So in short or in a nutshell, we can say that balance sheet is nothing but it is the financial position of an organization. By looking at the balance sheet, we will come to know the financial position of the balance sheet of the company or of the organization. The next one is the liabilities and the assets. So balance sheet consists of both your liabilities and assets. Liability will be on the left hand side, assets will be on your right side. And it is prepared immediately after preparation of your income and expenditure account. So once your income and expenditure account gets over, you have to start preparing your balance sheet. The end result of your income and expenditure account might either be surplus, if not, it could be deficit. If it is a surplus, then we will add the amount of surplus with the capital fund, whereas if it's a deficit, we have to deduct it from the capital fund. It is similar to how we used to give a treatment of the net profit and net loss. If we get a net profit, we will add the net profit with the capital in the balance sheet, and if it's a net loss, we will deduct it from the capital in our balance sheet. In the same way, for a non-profit organization, the surplus will be added with the capital fund, whereas the amount of deficit will be deducted from capital fund. Any doubts so far, students? Right. Moving on to find out the capital fund. What we have to use, what formula is there to find out the capital fund? This capital fund is otherwise we call them as general fund or corpus fund. So remember, the other name given to this capital fund is general fund or corpus fund. So if we want to find out the opening capital, then the opening capital is being found by using the formula capital fund is equal to your total assets minus your total liabilities. Last year, we all learned something called statement of affairs in our single entry system, where we prepare opening statement of affairs to find out your opening capital and closing to find out your closing capital. In the same way, even in a non-profit organization, we might be preparing the opening balance sheet and the closing balance sheet in order to derive the opening capital fund or the closing capital fund, as the case may be. But however, the formula to find out the capital fund is total assets minus total liabilities. Is it clear to you, students? Right. Now, let us try to ensure certain things before we prepare the balance sheet. There is an important point which we need to be taking into account at the time of preparation of our balance sheet. The first important term is to evaluate the value of your fixed assets, because on your asset side you will document all the assets, current assets, fixed assets and miscellaneous items, and on your liability side you will be documenting your current liability and the non-current liability and your capital, which is termed as capital fund. So you must be in a position to ensure what needs to be taken care of at the time of preparing the balance sheet. The first and the foremost is you must be in a position to determine the value of your fixed asset. For determining the value of fixed asset, you should take into account three important factors. They are: number one, the purchase of fixed assets, if any, during the year; the sale of fixed assets, if any, during the year; and the depreciation charged on the fixed asset. So all these three plays an important role in determining the value of fixed asset. The sale of fixed asset, if any, then it needs to be recorded in such a way that the end result from the sale proceeds, either profit or loss, will be appearing in your income and expenditure account. And the amount of fixed asset, that is a book value of the fixed asset which has got sold out, needs to be deducted from the respective fixed asset. So if there is a fixed asset, say for example a plant and machinery worth of rupees 1 lakh, out of the plant and machinery that is having a cost price of 1 lakh, book value of 1 lakh, if you have sold cost of rupees 20,000 worth of fixed assets, then the remaining fixed assets which should be documented in our balance sheet will be only rupees 80,000. And if suppose the sale what you did have resulted in a profit, then the profit on sale will appear on the credit side of your income and expenditure account. Suppose if the sale has ended in a loss, then the value of that loss will be appearing on the debit side of your income and expenditure account. So any doubt, students, so far? No, right? So when you are going to determine the fixed assets value, keep in mind whether you have done any further purchases, then the purchases whatever you did should be added to the respective fixed assets. Suppose you have not done any purchases, you have done a sale of the fixed asset, then in that case the book value of the sold fixed assets has to be deducted from the overall fixed assets value, and then the remaining portion alone should be shown in the balance sheet. And you must apply depreciation on the fixed assets and deduct the depreciation, show the net amount in your asset side of the balance sheet. Clear? Now let's move on to the next segment. The next segment is loans. Loans are nothing but any borrowings done by the organization. In a non-profit organization, there are possibilities whereby the NPO can apply for loans or they can get loans from the banks in order to meet their requirements or expenditures. And as you all know that loan is a liability for the organization, and this loan will be appearing on the liability side of the balance sheet. But when we receive the amount of loan, in that situation, we need to document the amount of loan as a receipt in the receipt side of our receipts and payment account. I repeat it, when we receive a loan from a bank or from any other member in order to meet the requirements, the loan form part of a liability, it will be documented on the liability side of the balance sheet. But you need to show the amount of loan as a receipt because you have received it. You have realized the amount. That amount will be shown on the receipt side of our receipts and payment account. So this is the treatment. Liability side of the organization, it's a liability for the organization, liability side of the balance sheet. And since you are received as a receipt, it will appear on the receipt side of your receipts and payment account. In this, you have to be very careful if there is any repayment of loan provided in the question. If there exists any repayment of loan, then you need to eliminate the repayment amount from the overall loan amount, and you need to show only the net amount of loan which is currently in existence. This repayment of loan will be appearing on the payment side of our receipts and payment account. So whenever we make a payment against the loan what we borrowed, those payments all will be captured on the payment side of our receipts and payment account. So let's take an example to understand the concept in a better way. There is a club by name X Club which has received a loan amount of rupees 1 lakh during the year 2018-19. And during that year itself, the club has repaid an amount of rupees 50,000 against the loan what they have got, that is against 1 lakh. Now, during the year end, that is on 31st of March 2019, the NPO has to prepare its balance sheet. This will be the format of your balance sheet, having a liability on the left side, having your assets on the right hand side. In your liability side, you will document this loan. When you are going to document the loan, it should not appear on the full value, that is 1 lakh. You should eliminate the repaid value of 50,000 and show only the current existing value, which is 50,000. So when any repayment of loan has been taken place, then you need to eliminate that repaid said portion of amount from the overall amount and show only the net amount. Able to understand? So I can even show in other way that the loan in the internal column you will show 1 lakh. From this less repaid 50,000, that will give you this 50,000. Able to understand? Right. Now, the third important points to be kept in our mind is advances. Loans and advances are different aspects. They are not one and the same. Loan is a borrowing done by the non-profit organization, whereas advances is nothing but it is an amount paid by a non-profit organization to those members who are in needful of funds. So a NPO can make a payment to a person of the organization who is in need of money for any purpose, and if that be the case, then the amount what the NPO has granted to that particular member will be denoted by the term advances. Say for example, in the same X club, there is a member by name Ram, and Ram needs a payment to meet some emergency, and he is getting his salary or something in advance. So this amount what the NPO is going to make as a payment to Ram will be denoted as advances. So now this advance will be an asset to that particular organization. So whenever an NPO makes any advances, it is nothing but it is a loan that has been provided by the organization, and that will be considered as an asset to that particular organization. And this payment, that is the advances what the NPO has made, will be shown in your receipts and payment account on the payment side. So any advances done by NPO will appear on the payment side of the respective receipts and payment account. At times, you may even recover the amount of advances from the member, and in that case, it will be considered as recovery of loan. There in the loans concept, we have seen something called repayment of loan. That means only when you borrow, you will repay. When you have provided, you will recover. So this is called recovery of your loan. Any recovery of loan, if it has happened against the advance what you have done, then those recovery of loan will appear on the receipt side of your receipts and payment account. I repeat it. Loan is a liability, whereas advances is a asset. A for advances, A for asset. The loan will be paid, that means repaid, during the due course of the business or during the due course of the period, which is called as repayment of loan. In the same way, the advances what you have offered will be recovered. That's called as recovery of loan. That is repayment of loan, this is recovery of loan. Repayment of loan will be appearing in your payment side of the receipts and payment account, whereas the recovery of loan will be appearing on the receipt side of your receipts and payment account. Any doubts so far, students? Right. Now let's move on to the next segment, the fourth one. The fourth one is valuation of your investment. Investment is nothing but it is a fixed asset. Like how we derive the value of a fixed asset, we must also ensure that the value of investment, what we are going to record in our balance sheet, is also Perfect. For this, you need to consider certain things. What are they? Number one, the amount of investment what you have done initially. The amount of investment what you have done further, if any. The value of investment what you have sold during the year, if any. So these three are the most important things to be taken into account while we record the amount of investment in the balance sheet. So the investment will be shown on the payment side of a reception payment account, because when we decide to make an investment, we need to release the funds from our end, which means we need to make the payment. When we are deciding to make some investment, obviously without paying the money you can't invest. So there comes payment. So the investment will be shown on the payment side of a reception payment account. Whereas you might realize the investment, there can be some portion of your investment getting realized. That means you may get interest on the amount what you have invested. If you are invested in some banks schemes like fixed deposits or term deposits like that, or if you are deposited in any shares or securities of the companies, then you may get a return in terms of dividends. So all these amount, that is interest or the dividends on those investments, will be considered as the realized amount on investment. So if there is any realized amount on the investment, then it forms part of your receipts. It is an income. So it should be shown on the receipt side of your receipts and payment account. The amount of investment will be appearing in our balance sheet. Since investment is an asset, the amount of investment should be shown in the asset side of the balance sheet. So when we deal with investment, make sure whatever the amount that you have invested will be appearing in the asset side of the balance sheet. The same amount will be shown as a payment in our reception payment account. And if you have realized some amount from that investment, either in terms of interest or dividend or anything else, then those income will be treated as a receipt for that particular organization and will be appearing on the receipt side of our reception payment account. Any doubts so far? Right. Moving on to the fifth important item. The fifth important item is adjustments related to the expenses and income. There are only 4 adjustments altogether that relates to your expense and income. They are outstanding expenses, prepaid expenses, unearned income, which is also known as income received in advance, and the fourth one is your accrued income. As you all know very well that outstanding expense is nothing but a payment which has to be paid or made but not yet done. So it is a liability to the organization, and thus outstanding expense will appear in your liability side of the balance sheet. The next one is your prepaid expense. Prepaid expense is an asset to the organization, and thus it is also known as an unexpired expenses. So prepaid expenses or unexpired expenses will be appearing on your asset side of the balance sheet. The next one is unearned income or income received in advance. Without rendering your service, if you have received the payment for the service, then it becomes income received in advance. Now, in this situation, it is the obligation of the management, that is the organization, to render the services for the income received in advance. So thus it forms part of your liability. Unless and until the work is not being delivered, this income what you have received against the services which is yet to be rendered will be treated as your liability. And then the next one is your accrued income. It is nothing but the income which we have earned but it is not received. So accrued income is an asset to that particular non-profit organization. So the important four adjustments are outstanding expenses, prepaid expenses, unearned income and accrued income. And remember, when we dealt final accounts with adjustments in our grade 11, we would have come across these four important adjustments, whereby we would have shown each and every adjustments in two different places. One compulsory in the balance sheet, and the next one it would have found a place either in trading or P&L. In the same way, even in non-profit organization, we have these four adjustments which should be shown in two different places. One in our balance sheet, definitely, either on the asset side or liability side, which we have mentioned it very clearly for each and every item. And the other place is your income and expenditure account. So each and every adjustment in your non-profit organization will be shown in income and expenditure account as well as in your balance sheet. Clear about it? Let's move on to the next segment. Yes, the next one is liabilities. Of course, you all know that balance sheet has got two important heads. The left side is a liability and right side is asset. So what to be recorded under liability? In liability, we will bring into account all those items which are still lying as a liability from our previous balance sheet. So from the previous year balance sheet, we need to scrutinize each and every items to ensure whether any payment is being done against them. If any payment has done, then you need to eliminate the amount paid and show only the net amount in your balance sheet. And do remember, the amount whatever you have paid against the respective liabilities will be shown or can be located from the receipts and payment account. It will be appearing on the payment side of your receipts and payment account. So whenever you are going to prepare the liability for the current year, you need to bring out the items whichever is still remaining as a liability in your books of accounts by looking at your previous year balance sheet, and in that you need to make sure if any payment is done against certain items of liabilities, then those payment amount to be eliminated and only record the net amount in your balance sheet. Able to follow, students? In this, you need to be very cautious. What is, if you ask, means there are two types of donations. One is general donation and other is specific donation. And the same way, grants are also of two types, general grant and specific grant. whenever we receive any specific receipt, that is donations or any funds for a specific purpose, it will not appear in your receipts and payment account but will be shown in your balance sheet. I repeat it, whenever you receive a receipt for a specific purpose or a donation for a specific purpose like building fund or building donation or annual dinner donation, etc., they are not shown in the income and expenditure account but will be shown in your balance sheet. I'm sorry, just make a small correction. It will not appear in income and expenditure account. Okay, so any specific donations or fund received for a specific purpose will not appear in your income and expenditure account, but it will be shown in your balance sheet. Example of such specific donations or specific funds are donation for the building, annual dinner donation, etc. These donations which you received for the specific purpose like donation for building or annual dinner donations can't be used for any other purpose except for the purpose for which it is been provided. That means the donation amount what you receive against donation for building should be used only for the building purpose and it should not be used for any other purpose or to meet any other expenses. In the same way, any amount that you have received for the annual dinner has to be used only for the dinner purposes, annual dinner purpose, and the amount can't be used for any other expenses. To meet any other expenses, you can't utilize the amount which is lying in the annual dinner. Right? Right. Now let's going to move on to the last aspect in our balance sheet, that is cash and bank balance. The next important item which needs to be taken into balance sheet is the cash balances and the bank balances. Cash and bank balance will generally appear on the asset side of the balance sheet, but you need to ensure the balance what it shows and take a call accordingly. Normally, the closing balance of the cash and the closing balance of bank will be taken up to a balance sheet. The closing balance of this cash and bank will be available in your receipts and payment account. It will be appearing in your receipts and payment account. Which side? It will appear on your payment side. Yes, the closing balance. So it will be appearing on the receipts and payment account. So payment side of it will appear on the payment side of your receipts and payment account. And the balance can show either favorable or unfavorable, which means suppose your receipts and payment account shows a debit balance, which means your receipt side is more when compared to your payment side, then that's called as debit balance, which is a favorable balance. In that case, whatever the amount appearing against the cash or appearing against the bank or both will be shown in your balance sheet under the asset side. Whereas if your cash and bank balance at the end of the year in the payment side of your receipts and payment account shows an unfavorable balance, that means overdraft balance or a credit balance, which means your receipts are less, your payments are more, then only it leads to an unfavorable balance. If the payments are more and receipts are less, then the balancing figure will appear on the debit side. That situation is what we call as unfavorable or overdraft or credit balance. Those unfavorable or credit balance or overdraft balance will be taken up to the liability side of our balance sheet. So when you prepare the balance sheet, the cash at the end of the year and bank value at the end of the year are to be documented. If they show a debit balance, it will be documented on the asset side, whereas if they show a credit balance, it will be appearing on your liability side. And finally, we will be adding the surplus with our capital fund, and we will be deducting the value of deficit from the capital fund. So, I hope by now you understood the important things to be done or to be kept in mind at the time of preparing the balance sheet, and what is a balance sheet is all about. Let's discuss upon the format of the balance sheet and the fund-based accounting in our next session. Thank you, students. Please don't hesitate to post your doubts or ping us if you have any doubts. You will be given up a short assignment on this balance sheet. Ensure that you complete those assignments on time and submit it to us. Thank you.